welcome to this latest video where I'll provide a quick update on markets and talk about the changes we've made to our portfolio in the recent days. So for the last 18 months, we've been focused on two key issues. One was the return of inflation, and the second was the sort of growing geopolitical sort of tension we're seeing across different parts of the world. And I think at last we're getting closer to some more positive news on the former. So over the next few months, we're going to see inflation peak, and probably quicker in the US than in the UK. Inflation sort of peaking, then start to come down, and then hopefully not long after, interest rates will peak and then start to come down, although that may still be some delay after that sort of peak in inflation that we actually see interest rates start to come down. And this has been one of the sort of the key drivers of the recovery in equity markets, over the last 3 or 4 months. With regards to our sort of other big concern, this rising geopolitical tension, no sort of real change there. But if anything, maybe there's some signs that some of that tension is worsening. So I think definitely something which we need to keep a close eye on. So let's turn to the portfolios and the changes which we've just made. So I mentioned in our sort of December updates, that because of our concern with inflation, we've been very underweight bonds, or almost maximum underweight bonds for the last sort of couple of years or so, in anticipation of this return of inflation. And certainly that position, helped protect portfolios when bonds fell very heavily last year. But in December, with a lot of pessimism, back in the markets, in the bond markets, we'd actually started increasing our exposure to bonds, and we're buying corporate bond funds with yields around 6%, which we felt was attractive. This time around, we're actually adding a little bit more into bonds. We've bought a new corporate bond fund with yields around 8 or 9%. This is investing in UK corporate bonds. It's not in sort of very higher risk or the high yield parts of the market, such as emerging market or junk. It's in the corporate bond space. So despite a little bit of uncertainty around the path of inflation and interest rates, we feel that these yields are attractive, with a manager who's got a good reputation of being quite nimble in this market. So we think not only is it the right time to lock into the attractive yields which we're getting, but also we should expect some good capital growth potential over the coming quarters, as inflation and interest rates start coming down again. Now, in order to fund this purchase of bonds, we've been trimming back our equity exposure just a little bit. We've sold our healthcare fund, global healthcare fund, just to sort of take some profits after its recent good performance. And we bought a new global fund which invests in quality value companies. This will typically be sort of financials and sort of consumer staples. Attractively valued, the fund's trading on a price earnings multiple around sort of 12 times, and is also yielding around 3%. And within equities, I'm just going to go into a little bit more detail in this video. One region which we continue to be positive on is the UK market. And a couple of points I'd make here. One is I think there's been a lot of pessimism about the UK economy, and we've been much more upbeat, I think, than most. I think there's even a growing possibility now that actually the UK will not fall into recession, which was widely predicted by the Bank of England just maybe sort of 6 months or so ago. But I think the other reason we like the UK market was it gives us exposure to two sectors which we particularly like at the moment, and which sort of continue to trade on attractive valuations. The first is commodities. So that's energy and mining, which will benefit from growing demand over the coming quarters, but also any sort of continued supply disruption, particularly coming out of this conflict in Eastern Europe. And the other sector which we like is the bank sector. We're starting to see some very strong earnings growth, and if you take the sort of the 10 years sort of pre-pandemic. They were spending all their profits on sort of PPI claims and restructuring, but now they've got high profit margins and returning a substantial amount back to shareholders. So both sectors have been largely overlooked for for the last 10 years, but they're undervalued and very cash generative. Hence, we've been increasing our exposure to these areas, for the last, 12, 18 months and more. Finally, our income models making similar moves, small reduction in equity and just a small increase in bonds in the same fund. So to sum up, we're still positive on equities overall, and the opportunities we're finding remain overweight, but it feels it's right just to bank some profits, after the strong run they've had over the last sort of 4 months or so. And it's almost as if sentiment has swung, from being perhaps too pessimistic last autumn to perhaps markets are getting a little bit ahead of themselves just at the moment, with this optimism around inflation. And I think we still need to bear in mind, we have still got this continued conflict, in Ukraine, and that just if it was to worsen, then that could unsettle equity markets. So therefore, it just feels prudent just to trim back our exposure to equities. I hope this was a useful update. That's all from me for now. Thank you.